Maybe just to start off, we'll take a few minutes to introduce ourselves and give you a little context about our opinions. I'll quickly start. I'm Doug Ellsbeck. I'm a partner in the real estate and funds team at King & Spalding. I work with real estate sponsors and investment managers in forming private funds, JVs, and other investment vehicles, as well as assisting with corporate advisory work, sponsor M&A, and other strategic transactions.
I'm Uma Moriarty. I'm the Senior Investment Strategist and Global Head of Sustainability at Center Square Investment Management, about a $15 billion investment manager, primarily based in real estate, but doing that across both public and private, as well as debt and equity platforms. And so really looking at real estate really across that entire spectrum and being able to glean a lot of the information, similar to kind of what Emmy was showing in terms of what the different markets are telling us in terms of valuation and things like that. So bringing all that together. So excited to share some insights on that front.
Hi, I'm Stephanie Chen. I lead our investor relations team at Trinity Investments. Trinity Investments is a hospitality specialist investing in hotels globally. We have an AUM of just under $8 billion. Strategy is really focused on value add, destination type markets. We're really a GP operating partner to a lot of institutional investors. And happy to be here today.
Hey everyone, David Moghavem, Chief Investment Officer of Trion Properties. We're a owner-operator, vertically integrated in value-add multifamily. We own about 6,000 units. We also third-party manage as well, a few thousand more that we just rolled out this year. And we are national. We have an office in LA, an office in Miami, and we cover throughout the nation.
Great. Thanks all. I guess our through line here is real estate's resilient path forward, how capital is underwritten and deployed when returns can no longer lean on falling rates or cap rate compression. We'll start talking about a bit of the macro picture and then kind of work down toward the ground. But with that, maybe I'll start with you, Uma. With inflation reaccelerating and monetary policy turning hawkish, where are rates and inflation heading, and how do you think that shapes outlooks across those sectors you just mentioned?
Yeah, so it's interesting, right? We talk a lot about what the Fed's doing, the hawkishness of the Fed, and how that's impacting interest rates. That only really is impacting the short end of the yield curve. We still have to really contend with the long end of the yield curve, which is being impacted by a completely different host of factors, inflation being one of them, right? But if I think about that 10-year Treasury yield, I tend to break it down in terms of real growth, inflation, and then a term premium. And we're really seeing upward pressure on all three of those factors, right? I think over the last month or so, the oil markets and the rate markets have really diverged in terms of where they're headed. And I think that's a function of the fact that investors are continuing to realize that there are multiple factors that are impacting inflation. So two of the big ones I would think about would be kind of the flow through impact of tariffs, as well as the spillover from all of the AI build out that we're seeing. And then the AI build out also has an impact on real growth, right? Over the last several decades, we haven't really seen true productivity growth in the economy. We're really seeing that ramp up. And then as we think about just the mounting geopolitical risks, and we're thinking about the continued fiscal spending and that deficit that we continue to grow, that term premium is also increasing. So investors are demanding a higher return for having their capital locked in for longer and longer periods of time. All of that means that you have to reflect that in real estate prices. And we saw a little bit of the data from Emmy, but what I think is really interesting is looking at, given the fact that we're looking at both the public and private markets, you can think about the real estate markets and the public side of the equation really being forward-looking and reflecting what valuations should be. They do that much faster, right? So if I think about the REIT market today in the U.S., trading at a 5.4 cap rate, if I take out Welltower, which is the largest senior housing operator, trading at a sub 3% cap rate, that turns into a 5.7% cap rate. And so that's where real estate in the public markets is generally trading. When I take a look at where kind of core markets are trading and think about the Odyssey index, those appraisals are still kind of in the 4.5% cap rate range. And that ranges anywhere from kind of a sub 4 number for industrial all the way up to kind of like a 5.5 for retail office. And so that in the context of a 10-year Treasury yield, which as of this morning was called like a 4.4, doesn't quite make sense. The spread in terms of that pricing, if I am an institutional investor allocating capital, why would I deploy capital today in core multifamily as an equity provider where you have so much more risk from a fundamental perspective as supply is coming through versus just being able to put capital into the 10-year treasury yield, take significantly less risk and essentially earn the same return, right? So I think there's broad understanding of the fact that we need to figure out how to really unlock this valuation disconnect that exists in the private markets. You've seen it in transaction markets, right? Those are adjusting a bit more rationally. I still think there's a bit of irrationality in some of the property types in terms of where valuations are. But broadly speaking, you're seeing the transaction market move, but you're not seeing appraisals really move in tandem, which is creating this issue of the bid-ask spread, which persists in so many parts of the market. So you have all this capital stuck. And so that's a whole other conversation, which I think we'll get into. But that's, as I think about some of the big drivers, I think about the fact that we're in this higher for longer interest rate environment, valuations have to adjust. And then from a return perspective, you're not getting that cap rate compression to really drive returns over a long period of time. You're having to really deliver that at the asset level from an asset management perspective. And that's really where we're seeing a lot of focus, both from the perspective of how we're deploying capital, but also the perspective of how allocators are thinking about the investors that they want to be deploying capital with. Do you have the ability to really roll up your sleeves and squeeze as much juice out of your asset as you can during your hold period is really, really critical.
Maybe taking a different look at the same type of information. David, as a multifamily operator, how are inflation and shelter costs showing up vis-a-vis your tenants? And maybe where is the published data kind of getting it wrong or showing something different?
Yeah, so great perspectives all around. Yuma, I think you had also a great perspective of where markets are trading on the real estate side versus where the REITs are trading and where the treasuries are at and the disconnect behind it. I think one of the other disconnects, kind of boots on the ground, is you're seeing the print and you're seeing how shelter is showing north of 3%, but the reality is the data can be skewed with the owner's equivalent, which I'm sure people in this room know about, and the surveys that, they're not actually tracking where rents are and where rents are moving, but rather a survey of owners of, hey, where do you think shelter costs would be if you were to rent this out? And so it's also it's a lagging figure. What we're seeing boots on the ground is not much rent growth with a caveat of a few specific markets, maybe the Bay Area or supply constrained markets. But the supply really has made rent growth even negative, especially in the workforce B class, C class spaces, and softening in the A class space where there's a lot of supply. But with that said, I think you're seeing, again, with boots on the ground, a lot of renters starting to feel the pinch, starting to feel a little stretched. You're seeing delinquency starting to tick up. Maybe some markets worse than others, but I think bad debt used to be a little bit more of a rounding era during when interest rates were at zero. Now everyone's hyper-focused on it. So I think that's the boots of the ground perspective here with some of these global economic impacts. What does this mean for renters? I think there's a shift now from the cap stack distress that we've been seeing for these past 2-3+ years to now a shift towards a potential operational distress or cracks in the performance in multifamily.
Stephanie, maybe turning to you on the hospitality front, with these inputs and also just general geopolitical hotspots around the globe, how are you viewing that and how is it affecting hospitality performance?
Yeah, so obviously hospitality is a little bit different relative to a lot of these other asset classes. It's very nuanced as it relates to the operational intensity of it, right? I think the inflationary environment is actually a benefit from a hospitality perspective because it is an inflation hedge, right? We, from a hotel's perspective, change our rates on a nightly basis. And so what we can do from that perspective is really yield manage our revenue and really kind of, adjust our rates as appropriate on a daily basis. I think with what's going on around the world, there's definitely hot spots as it relates to regionally and globally markets that are seeing a bit more of some headwinds and others that have a bit more tailwinds. I think overall, from a hospitality perspective, I think on a transaction standpoint, cap rates have definitely widened relative to kind of where we were pre-COVID levels. And I think a lot of that is due to travel demand and how kind of the tourism industry is rebounding. Obviously with COVID, the pent-up demand and pent-up want to travel created a different perspective for a lot of individuals. And now what you're seeing is for discretionary spending, the allocation of that, a big chunk, about 70%, is really being allocated to experiences, right? And so what does that mean? That translates directly into tourism and travel, and for the hotel industry has done extremely well. So I think from a manager's perspective and an operating partner's perspective, it's really our job to find kind of the hot spots from that. And really the upper upscale and luxury segment of hospitality is where we're seeing a lot of that rebound and recovery. CoStar just kind of released their forecasts for 26 and for 27. And really those two segments are the ones that are continuing to outperform kind of that upscale, mid-scale, and kind of select service segments. Obviously, the lower tier segments are a bit more cautious and impacting from just overall costs, right? So I think that's really important. And obviously, from an operational perspective, expenses and being able to yield manage that is also very critical.
And maybe I'll come back to you, kind of turning toward kind of what we're seeing from investors, but also what we're seeing from an underwriting perspective. Could you talk a little bit about Center Square and how your underwriting assumptions have changed maybe over the last 18 to 24 months?
Yeah, I think we were maybe early in terms of pounding the table and saying we were going to be in a higher for longer interest rate environment. We've been saying that for, I don't know, four plus years at this point, which meant that over, call it, last 12 to 24 months, where a lot of excitement was building around the fact that Fed was going to be decreasing rates, and we were going to see the interest rate environment shift in favor of a lot of real estate underwriting, maybe mistakes that had been made during kind of a zero interest rate environment. That still wasn't really what we believed, right? And so we were kind of maintaining that discipline throughout from an underwriting perspective, which was helping us continue to really refine the subsectors, as Emmy was mentioning, where we really believe the best opportunity to deploy capital. So that being said, the places that we've been really excited from, let's say from an industrial perspective, we were doing more broader industrial investments kind of across the spectrum, where we had everything from kind of last mile industrial to cold storage and some more traditional kind of regional warehouses, to the focus that's really shifted towards infill, small bay, multi-tenant industrial, where kind of to the point also that Stephanie mentioned, a lot of the spending continues to be in the services side of the economy. And so the tenants that we're really looking for are those service-based providers, right? So it's your HVAC repair person, it's maybe the car mechanic, it's maybe a CrossFit gym, things like that. Those are the types of tenants that we're really focused on, that are serving the rooftops within their trade area and really focusing on finding irreplaceable assets. I like to say that these are maybe very, not the prettiest assets, but really beautiful economics. And so those are the types of things that we're looking for. They're yielding cash first and foremost. We like the cash flow aspect of a lot of the assets that we're looking at, but really focusing within the niches where we have found there isn't a ton of capital chasing after these particular assets in the areas that we're looking. So you don't have the same kind of cap rate compression that you're dealing with that had been happening over the last couple of years, but then also focusing on places where we find the fundamentals to be really, really strong and durable based on what we're seeing, where you have no new supply coming in, right? These tend to be assets that are in highly dense infill locations where the highest and best use of that land is actually really going to be probably multifamily. So the net supply of these particular assets is actually going down in many different markets. So you have a negative supply momentum and demand that has been really, really resilient and robust because you continue to see the need for service-based vendors and providers across these economies that continue to grow. And so that demand supply imbalance is kind of the key focus that we've been thinking about and really helping to shape the particular subsectors within industrial, retail, and rental housing where we're deploying capital. So I think that's been one of the changes maybe in terms of the focus within the sectors. And then the other thing that I would also say is because of our ability to deploy capital across the capital stack, the other thing that we've been doing much more of, especially in rental housing, where we haven't seen valuations really correct to where we think they should be based on the fundamentals on the ground across all these different markets, is instead of taking equity risk, we're moving down the capital stack and really deploying capital from a kind of a mezz debt and pref equity perspective. And so making sure that the risk return profile as we're deploying capital in the capital stack makes sense for what we believe to be the most optimal opportunity within that particular asset class. And then also within a broader sector, finding the niches where we believe the fundamentals to be most protected as we look forward from a supply and demand perspective.
Maybe building on that, Stephanie, as you're finding your, investors for your product, are you seeing any trends in kind of preferred investment strategies that they are seeking out or things that they're shying away from?
Yeah, I think from a hospitality perspective, on behalf of our investors, we really focus on assets that have diversified demand bases. So ones where there's not only kind of that transient leisure perspective, but there's also a group base. A lot of that comes down to what I was talking about earlier is yield managing the business, right? As everyone knows, for hospitality, it's a very cyclical life cycle, whether that be within the year or within kind of that hold period. And so what's ever important from a hospitality perspective, because from an asset management standpoint, you do have so much more capacity to drive performance to really kind of yield manage that. And so with the group and kind of transient perspective, being able to have that group base during times of kind of slower leisure or slower transient periods is really important. And so what you'll see in our portfolio is our assets are a bit larger in scale, right? So to accommodate a lot of the group and leisure component, you have to have the meeting space similar to this asset here to really kind of drive that group demand. So we're seeing a lot of that from a trend and just overall investment perspective, and then really kind of the destination markets, right? Not only just kind of the resort markets, but really kind of the urban resort concepts where a lot of the demand is flocking to, just because of, again, the demand perspective of wanting to yield manage this business and have kind of that strong demand base. And that's really where the markets are seeing the biggest tailwinds. So Sunbelt markets, some of the urban markets, et cetera. But going back to what I said earlier, the expense side of our business is definitely a huge consideration because of the operationally intensive nature. So labor, as an example, is a key piece of how investors are viewing some of these markets, right? Some of these very urban core markets, unfortunately, labor costs are exceeding kind of the revenue growth. So that's definitely an area where investors are being a bit more critical and a bit more cautious on. But going back to kind of this whole theme of demand and supply, especially in these assets where you have kind of that group and leisure business, there's a huge lack of supply, right? I think if you look across the spectrum from a new supply perspective, it's quite minimal if you look at kind of that 10-year historical trend. So I think, overall, I think the demand supply fundamentals have been very attractive from the hospitality.
David, kind of moving to you. You mentioned kind of the credit risk and how it's a little different now than in prior years. How have collection issues for tenants or tenant inflation affected how you're viewing underwriting for renovations? Talked a little about rent growth and also just general operation.
Yeah, I mean, pre-rate hike, the North Star that we would be looking at is pro forma untrended yield on cost, what the property's gonna become when you do renovations, when everyone, the key term was trade outs when you would tour property. Now we're looking at day one yield, net of deferred maintenance, net of gain to lease, net of the rent roll deterioration on when a tenant moves out and you're probably leasing it lower than what the previous tenant was leasing at. So that's kind of our North Star. Looking at where bad debt is, looking at an AR report and really analyzing how many tenants are in eviction, how many of those tenants that are in eviction are probably going to pay late versus not pay at all. what comparable properties are operating at, just being hyper focused on the true in-place metrics, not just what's on trailing financials, but forward-looking how it could deteriorate. And if it can still stand on its own 2 feet, if it could still be cash flowing, positive leverage, back to the basics, right? How the OGs in real estate would look at deals. Like I think we're going back to the basics. I think it's pretty healthy that we're going through this reset. And I think for us, there's some opportunities. I think Yuma gave a good point how there's a lack of there's some properties now or some parts that have a lack of capital flows, and that's where I guess Center Square is starting to play in. And for us, we're starting to play in that space too, in the, call it, sub-institutional space. Doesn't have to be a 1970s or older property that has a ton of deferred maintenance, but somewhere where the REITs may not be playing in as much because, those are sub 5 caps, somewhere in between where you can get good yield in great markets with good fundamentals and net of deferred maintenance, net of gain to lease, net of some of the headwinds, still be positive leverage. I think that's a great opportunity right now. Multi.
Maybe shifting to kind of the investor sentiment and kind of capital flows. Uma, how are you seeing investors preferring to access real estate today? I know you guys are kind of across the spectrum in what you invest in, but also product, how are you viewing commingled funds versus other types of alternative vehicles that they can invest through?
Yeah, I think, and this is mentioned in the last panel, over the last call it 5 years or so, a lot of investors that were invested in real estate commingled funds where they had less agency in terms of really pushing the gas and the brake in terms of capital deployment, et cetera, have found that they have been disappointed with the distributions that they've received, the liquidity that's been available. So there's a lot of capital that just remains kind of stuck in the system, right? And it's kind of this virtuous cycle where a lot of investors can't deploy new capital because they can't raise new capital. The capital that they're trying to raise hasn't received the capital back because the transaction market is too slow and it hasn't quite unlocked yet. And so it's this virtual cycle that kind of keeps on going. So we're still waiting for that forcing function to kind of really, really accelerate that transaction market in a way that can really give investors a lot of that liquidity and that kind of stuck capital back in their pockets. But I think what that has really meant is that investors have shifted towards just wanting more agency in the way in which they're deploying capital into real estate. And so the wrapper with which they're trying to do it has really shifted from being this commingled fund where maybe they don't have as many rights as it relates to the way in which that capital is being deployed to more of like a joint venture, separate account type of a structure where they have more agency. That being said, not every single investor out there can do that, right? So we primarily are investing on behalf of institutional investors. You still have a lot of institutional investors out there that have very large pools of capital and very, very small teams. And so they simply don't have the capacity to be able to work with us on a joint venture basis and say yes or no to every single deal that we're putting in front of them. That's just not part of what their team was built to be able to do. And so for a lot of those investors, you still need to have the commingled funds out there. That way they can use the resources that they have to be able to kind of deploy capital in that way. But I would say that the bigger shift that we've seen has really been from the perspective of a lot of sophisticated institutional investors seeking more agency in the way in which they're deploying capital into real estate. That being said, I think the wrapper with which institutions look to invest capital into real estate is also very cyclical in nature, right? So the pendulum has swung kind of towards one direction today. But I think as investors start to understand the resources required to actually have that discretion on the capital deployment side of the equation, they're going to start to get a little bit inundated. And you'll see this pendulum kind of swing back. But at least for now, we're seeing it shift more towards joint ventures, separate accounts, club deals, ways in which they have just more direct investments and more agency in the way in which they're deploying capital.
Just to tack on to that, I fully agree with that, especially the stratification between types of institutional capital. People with larger teams being able to be a little more hands-on and wanting to be. With that, I think part of the differences between those truly commingled discretionary funds and a JV, we've been seeing a lot more sidecars and other vehicles that maybe have a deeper pool that's discretionary or co-invest vehicles alongside.
Yep. And a race in the bottom on fees.
Fees don't go up on those relative to the commingled funds. I know we're getting low on time, so I'll probably reduce a couple of these. But Stephanie, on this, I guess from an investor perspective, are you seeing domestic versus international investors viewing U.S. hospitality the same, differently? Are you seeing anything that's been changing over the last, year and a half or so?
Yeah, I mean, obviously the geopolitical environment and what's been happening over the past few months have put a bit more caution to a lot of the international investors investing into the US on the hospitality front. What I would say, though, on the flip side to that, I think there are still some opportunistic international investors that see US as a safe haven, right? And so they are allocating capital to the US to really kind of park their capital there from a long-term perspective. I think hotels specifically, though, kind of on the contrary, I think some of the international investors stepped into the market on the hospitality front historically thinking that, hotels were, these great asset types that wasn't as hands-on or didn't need as much of a hands-on approach than maybe what is actually required. So unfortunately, I think what's been happening with the hotel environment is I think a lot of these international investors are recognizing that they really need local operating partners to be able to invest on a JV or a kind of fund basis to be able to kind of get that experience and that exposure. So with that being said, I think you're seeing less on the direct side without kind of a local manager in tow as a result. However, I think for a lot of these core landmark assets, right, those that are kind of in that ultra luxury in the core urban or even core resort type of destinations, they're still attracting a lot of these international ultra high net worth type of investors. A lot of that is due to the fact that obviously these trades don't happen every day. A lot of that is due to kind of those existing owners are typically ones that are longer term holders. And so what we're seeing now in the market is some of those assets actually coming to market. And so as a result, those are still attracting a lot of the international capital. And so I think it's obviously a case by case basis on an asset level and also a market level perspective. I think domestically, private equity is trying to maintain kind of the activity level. I think across asset classes, right, we're seeing kind of private equity have the ability to deploy capital, but maybe not finding the right type of opportunities. And so I think that's still the case in hospitality. I think depending on what asset types and what you're trying to look for, I think is really kind of driving the activity from a private equity standpoint. But we're seeing a lot of interesting opportunities come about, again, from a value add perspective where these assets have not been renovated in the past, let's call it 5 to 6 years, because of the capital constraints and because of COVID and what was happening kind of thereafter. And so that's where, we're seeing the opportunity as it relates to kind of a lot of transaction.
I know we're about 5 minutes right now. Can move to Q&A if there's any coming through, but maybe while we wait to see if some come through, kind of with that, where the opportunity is that you're seeing. Maybe David, you can talk about what you're seeing and where maybe mispriced opportunities are in your arena, or how you're seeing where the value is.
Sure. And actually, to piggyback from what Stephanie was saying about with hospitality, foreign investors didn't realize the management intensity of it. It's very similar parallels on the multifamily side. I think with all the rent growth, it was kind of saving the pro formas and not really showing the cracks in operations. But anyone that's in multifamily knows it's super management intensive, and us being vertically integrated has really showed how we've been able to kind of manage ourselves out of some of the troubles because we don't have rent growth saving us anymore. So how does that look like? For now, we're now seeing opportunities on the management side to get our foot in the door, to talk to distressed owners and come in and help, maybe even doing some sort of GP replacement, talking to lenders who have had to take properties back and managing for them as a foot in the door to potentially buy the note or buy property in REO. It's opening an incredible amount of opportunities, also scaling our third-party management platform, getting potential growth equity to come in, because now we're actually seeing JV partners come in, not to JV on one-off deals, but to invest in platforms that are vertically integrated like ours, platforms that are with operators that are getting their hands dirty. Because as Stephanie noted, now the cracks are showing throughout every asset class, and management's really the key to get ourselves out of this.
Looks like we have a couple questions. I did not plant this question. So, what's your advice to an asset manager seeking to broaden and grow their investor base? Look, I think, the last couple of years has been somewhat difficult in a commingled fund space, particularly for fundraising. I think it goes back to, Stephanie, you mentioned, or maybe Uma, where people aren't getting their capital back from prior investments, so they have less to deploy right now, or they're at least slower to deploy that or redeploy. I think one of the things that we've seen success with some of our clients is they have a more nuanced story. They're not just in retail overall. They're not just industrial. They have a very focused view. Kind of, Emmy, going back to your niche areas of industrial, for example, and having experience there, but also an investment thesis that tracks one of those. So a lot of what we've seen be successful and maybe opening some doors is somebody who has that expertise, who can provide that opportunity maybe in a more focused way than something that's more broadly in retail or industrial. On the next question, to what extent are rent stabilization, housing legislation, and other regulatory changes reshaping private investors' conviction across real estate segments? Anybody want to take that?
I mean, I think especially in rental housing broadly, right? You across the entire spectrum. I mean, obviously BTR and SFR was pencils down for a while this year. I think as of yesterday, still pencils down. It seems like maybe from an actual impact perspective, this legislation might be a little bit of a nothing burger and more of kind of political headlines than actual impact on the way that capital can be deployed in the space. But though it's interesting, one of the few kind of bipartisan areas of support seems to be around housing. And so as we think about the way in which we deploy capital at Center Square, we have a very kind of systematic way. We have a scorecard. We build out kind of the factors that we think are really going to drive performance, and we're really scoring assets across all of these as part of kind of a filtering mechanism. And as have been kind of reassessing that scorecard, especially for rental housing, and we continue to tweak it to make sure that it demonstrates efficacy with assets actually performing in line with how we're underwriting them. One of the parts that's different for us from a rental housing perspective compared to the scorecards that we have on retail and industrial is really from a policy risk perspective. And I think that has been a very different and more kind of impactful part of an underwriting process in terms of rental housing recently, because of the shifting political environment and focus on that asset class, which I think is different, right? So as we think about the risk premium that you require in some of the markets where you could be facing legislation that impacts your expectations from an underwriting perspective, different today than it was 12 to 24 months ago. I don't know if you guys are viewing it differently, given that's your focus.
No, I mean, we cut our teeth buying in California and Oregon. And when COVID hit, we said, shoot, we're so exposed to this political risk. We opened our office in Miami, started buying in the Southeast, and now there's insurance and supply issues, right? So you got to pick your poison. Everything has its own risk. You got to know what risk you're getting into. And political risk, harder to quantify, that's for sure. But there's something to be said, too, of some of these politically risky type of submarkets that also might not have as much supply. Right. And so it's about picking your risk, knowing what risk you're getting into, and having, risk adjusted returns based on that.
They took away the questions, and I think we're done with our time.
I like that last question. You can't eat your IRR, but you get your promote from it. I know we're out of time, but whoever asked that, it's a good point. And I think going into this next cycle, maybe we are going to see a difference where interest and incentives for operators will be aligned with investors, where you don't have to sell for an operator to make money. We can come up with the structure, and we're doing that already, where interests are aligned between investors and operators.
All right. Well, thank you all for the presentation and discussion. Looking forward to the rest of the day.